While it's nearly impossible to predict when the real estate market will peak, it's still important to try and gauge where we're at in the real estate cycle. Real estate regularly goes through multi year cycles of boom and bust periods, which can be broken down into four periods: recovery, expansion, hypersupply, and recession. Understanding where the market is in this cycle can help homeowners and investors make smarter decisions about buying, selling, or investing. So, what are the four phases of the real estate cycle? Phase one, recovery. The characteristics of the recovery phase include declining vacancy and no new construction, with more tenants looking to sign leases. There may also be a glut of foreclosures on the market. This is when the savvy investors look to buy new assets, although securing financing during this phase can be difficult, and overall sentiment is still negative. This marks the contrarian phase, in which value investors buy at low prices. Phase two, expansion. Many markets find themselves entrenched in the expansion phase, which is a time of declining vacancy and new construction. It takes a few years for new inventory to come online, and during this long term period, rents and occupancy both expand. During a peak, everyone wants to buy real estate, and real estate prices reach record highs. The fear of missing out leads to panic buying, and home equity loans become all the rage. However, properties start taking a little bit longer than usual to sell, and housing becomes more unaffordable in normal markets. Phase three, hypersupply. This phase is characterized by trouble brewing on the horizon. Vacancy begins to increase and new construction is still ramping up. This is a period when builders need to recognize that oversupply is occurring and should put the brakes on new construction, but often they don't. Panic selling begins and we begin to see rapid price reductions for homes. Housing, affordab- Housing affordability begins to increase and new construction for new homes freezes. Phase four, recession. Housing prices begin to stabilize during the recession phase. Few people are willing to invest in real estate, and investors with experience, capital, and track records can raise funds for investing. For example, during the recession phase in 2008, the occupancy rate was decreasing, and the new completions were being delivered to the market. The new construction came to a halt, but it was a little too late. There was a double whammy: fewer renters plus the addition of new inventory. Rental rates as well as occupancy continued to plummet, and this accelerated the downturn in real estate values. While macroeconomic indicators can be great for cocktail parties and debates, the specific property you're looking at should drive your investment decision, not the macroeconomic forces. To be successful in real estate, you need to know what your financial goals are and what makes a potential deal good for those goals, your particular goals, that is. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281 222 0433. Hope you have a good day.